Every day, investors put their money to work in the stock market. But what is investing? Investing is buying something today, like a stock or other security, with the expectation that it will be worth more in the future. In this way, investors aren't just paying for what they think a company's stock is worth today, but what they believe it might be worth in the future. That means that stock prices today reflect investors' future expectations. For example, one investor may interpret a company's recent data as the potential for a much higher future profitability. Based on that expectation, the investor may project the potential higher earnings in the future and estimate a reasonable price for the company's stock that discounts those higher future earnings to the present. And that's the forecast upon which they invest. The world is full of investors, both institutions and individuals, each one researching and analyzing data about the future prospects of companies and the economy, then investing based upon what they learn and what they believe. That means around the world, there are millions of investors buying and selling based on their future expectations. Taken together, all these investors make up what we call the stock market. With contributions from all those investors, the stock market acts like a huge information processing machine. Any new information, ideas, and opinions that shape future expectations are almost instantaneously reflected in stock prices through the process of buying and selling. In this way, the stock market tends to be one of the most reliable, forward-looking economic indicators. Let's look at this from the market's perspective. We believe markets look into the future between 3 months and 30 months approximately. Why those boundaries? Remember, the market is full of investors pricing in their future expectations today. There's often too much noise in the short term to make any meaningful forecast shorter than 3 months. And the further out an investor looks, all the possibilities and unknowns begin to multiply and compound upon themselves until there are so many variables and possibilities, it's virtually a guessing game. During bull markets, stocks tend to focus towards the far end of the 3 and 30-month range. But when something huge and unexpected happens, the market's focus shifts closer to 3 months as investors process the potential impacts. Once investors digest the new information and it's reflected in stock prices, the market shifts its focus back toward the far end of the range. Here's an example. Throughout 2019 and into early 2020, the market seemed more focused on the future towards 30 months out. The first reported COVID-19 case arose in December 2019. In January 2020, the virus's pandemic potential drew broader media attention, and China instituted the first lockdowns. But stocks were still rising. But then, in late February 2020, local and national governments around the world began considering business lockdowns to combat the spread of COVID-19. The stock market then drastically shifted focus to the near term as investors anticipated widespread containment efforts and assessed the impacts to businesses and consumers. The result? The market plunged over 30% in 33 days, creating one of the swiftest bear markets in history. Then, by late March, markets began to shift focus back toward the longer end of the range, as investors anticipated lockdowns easing and the economy eventually recovering. As 2020 proved, the market doesn't need glowingly optimistic developments to move higher. Because the market moves on the difference between expectations and reality, stocks can still advance, even if investors expect the future to be only slightly less worse than feared. As 2020 progressed, gradual reopenings and rebounding economic activity, such as retail sales and industrial production, confirmed what the stock market recovery had indicated since March 23rd. Understanding the market's forward-looking focus is critical. It can help bring clarity to investment decision-making, helping investors separate hype from the true fundamental factors that influence markets. To learn more, be sure to click the subscribe button and ring the bell to be notified when we publish new content.